third risk webinar. We're gathering today on the subject of default time horizons in GIPS and FRM certification. We appreciate you being here with us. Our panelists today are the exact right people that you would want to have to discuss this topic. We have Ian Makara, the CFA Institute's Director of Investment Performance Standards for Europe, Middle East, and Africa. Mark Carey, Co-President of the GARP Risk Institute. Allison Taylor, a behavioral scholar for NYU Stern School of Business and Executive Director of an in-house research institute there called Ethical Systems. And Jacques Longerstay, Chief Risk Officer at Nuveen. We appreciate each and every one of you being here. I'll open the conversation momentarily. First, let me say this is exactly the right panel for the topic because we have a very special focus today. We're trying to understand the real world behavioral implications of some very specific, somewhat technical elements of statistical risk management for investing. We'll tie it all together for what it means for long-term investors. FCLT Global's purpose in hosting this webinar and the series is to apply our research in a way that helps move money in longer-term directions. You can find that research on our website under the domain fcltglobal.org/resources. When you arrive, you'll see a publication called Balancing Act, Managing Investment Risk for Multiple Time Horizons, and also a supporting publication on institutional investment mandates that alludes to some risk provisions. I'll also mention a few brief programming notes, and then we'll throw it to Mark and Ian to get us kicked off. First, though, I have a colleague, Bryn Costello, who is producing the webinar today. You can email her either with technical challenges as you may encounter them, or with questions for our panel at bryn.costello@fcltglobal.org. This webinar is being recorded and archived on FCLT Global's website in the spirit of continuing professional education and to make it available for investors whose time zones are not appropriate right now. We'll talk for promptly 60 minutes and wrap up exactly at 9:30. So with no further ado, I appreciate everyone being here. And Mark and Ian, I'll turn to you first with an introductory question. We know that the FRM certificate and GIPS reporting represent defaults for the way that investment risk professionals do their work. I'm curious, in what ways do the defaults that your organization set have implications for investment time horizons? Ian, perhaps I'll start with you.
Okay, thanks very much, Matt. Thanks for the introduction. It's a very interesting question because the reality is that the Global Investment Performance Standards, GIPS, are actually designed to ensure that a minimum set of information is delivered to every prospective client. GIPS actually doesn't address what existing clients should be receiving. We actually address that in two different codes, which we call Principles for Investment Reporting, or a Guidance to Effective Investment Reporting, where we're very much stressing making sure that the providers of the information are consistent in terms of what they provide to the recipients, so that the providers understand what the recipients want. And that speaks to this long-term horizon that you are trying to encourage in terms of investors looking at, rather than the short-term issues. But with respect to GIPS, we still nonetheless, as you say, have some defaults that need to be delivered. And that would be a minimum for any firm that is claiming compliance with the GIPS standards, a minimum of 5 years of actual ex post data. Everything we do relates to actual data, actual management of assets, no hypothetical, no joining together of hypothetical with actual. So purely looking at actual. And what we were trying to address originally, way back in the 1980s, in fact, was that it was a Wild West. It truly was. What you got, how it was generated, what was in there, what was left out, the periods that were presented. You know, you would select, or somebody would select 5 months, annualize it, and say, over 5 years, this is the return that you could get, with you could get being in very, very small type. So you wanted to standardize what went into it, how it was calculated, what was presented, and also what was disclosed. Okay, so minimum of 5 years that we have on these reports, which builds to 10 over the additional 5 years, and it covers not just an individual account, an individual portfolio, the rep account, the longest portfolio that you've been
Right.
managing. It's an aggregate. Everything that is managed according to the same strategy is aggregated together as if it was one large portfolio. And that is the performance that is presented to the prospective client. So there's no cherry picking. So we've got a minimum set of time, 5 years,
Mhm.
annual information. We have all of those periods, not some. It needs to be updated at least every 12 months. So from that perspective, we're not pushing people to report monthly or quarterly. We say at a minimum every 12 months. So we are looking to have more of an in-depth understanding of how that product has performed. In addition to the product, there's got to be a benchmark, a realistic benchmark for that particular product. There also has to be some indication of risk, which in the GIPS standards at the moment is very, very simple. But the
Mm.
reason for that is that we're looking for consistency and comparability. So somebody that's receiving a report from many, many different managers, um, the simplest measure of risk we could come up with was a 3-year annualized standard deviation based on monthly returns. Now, I know there's been discussions in the past, in past sessions that you've had, about the frequency, and frequency is absolutely key. Um, you have to disclose the frequency that you are using in terms of the returns for the risk measure. We use monthly returns to build up the longer term periodic returns. We use those same monthly returns in the risk measure. Okay, but that
Sure.
is as much to be pragmatic. You want people to adopt the standards. You want them to be able to deliver the information. There's a cost benefit analysis. The other thing to think about is also too much information. This will speak to Alison, I'm sure. Too much information and the recipient will just glaze over. They ignore everything. This is
Right.
why we end up with a KID in the PRIPS regulations, which is held at 3 pages, maximum 3 pages, because otherwise the investors are going to completely lose interest. They won't, not only will they not read those disclosures, but they won't read anything. They'll
Right.
just glaze over. So you've got to be careful in terms of what you're asking for. But we have the product, the benchmark, some risk indicators for both, some information on fees, because yeah, you get a return, but at what risk and at what cost?
I
That's key.
appreciate that. I'm going to jump in here and give Mark a chance to say about the way that time horizon defaults are present in the FRM certificate. And then Allison, I will turn to you very much to pick up on the point that Ian just made about the usability and the cognitive load, making sure that you don't overwhelm people and the trade-offs that you might make. But first, Mark, let me turn to you to answer the same question. In what ways does the FRM certificate have defaults related to time horizon?
Well, the FRM really doesn't have any defaults built into it at all. GARP is a professional association for financial risk managers, and the FRM is a certification, much like the CFA is. And what financial risk managers do in investment management or asset management firms is, in addition to making sure the regulators are satisfied, a primary responsibility is monitoring the portfolio managers. So the kind of risk management that you would do to make sure that you are following an investor's mandate is going to be done primarily by the portfolio managers. And the risk managers are going to focus largely on making sure that the portfolio managers are not departing from the mandate. In a situation where the mandate includes a requirement to focus on a long-term horizon, there's going to be a need to develop metrics, basically, to try and indicate whether the portfolio manager is doing their job. And FRMs are well positioned to do that because there's a lot of quantitative stuff involved in financial risk management. But risk managers also, especially as they become more experienced, become adept at thinking broadly about the nature of the risks. That's really what somebody like Jacques spends a lot of his time doing. He's not thinking that much about the fine details of the quantitative stuff. Instead, he's thinking about ways in which risk may be influenced that are not going to be picked up by the quantitative measures at all. I will say that in that sort of broad way of looking at the world, if one is going to offer a product that explicitly has an investment product that has a long-term horizon built in, you're going to have to think hard about how to communicate well with the purchasers of that product, with the ultimate investors, because their behavior is going to be very important to long-term performance. If you've got a 10-year investment horizon, you can pretty much count on some bad times in that horizon.
Right.
And if the investors decide to pull out at the very worst time, that's really going to influence not only the return, of the fund, but also the return that those investors receive. And so one of the things that a financial risk manager at an investment house is going to do is try and make sure that communication with the investors is effective, and that's going to involve a good understanding of behavioral stuff.
Sure.
If I can just comment on what Mark said, and I think it'll be a good introduction to subsequent comments by Allison as well. In the time that I actually spent more on the retail high net worth side, this aspect of communicating sort of risk expectations over various horizons, made me aware of this kind of breakdown between how people think about risk in calm markets and what their risk appetite is in calm markets versus what their behavior actually ends up being when the markets are actually falling apart. And you can have a very quiet conversation about expected vol, tracking error versus benchmark, when the sun is shining and the markets are up, and people say, "Yeah, no problem, I can take a 20% loss in the value of my portfolio," until that happens. And then the behavior totally changes. So continuing to work on articulating that, and if we could actually create some kind of simulation that would allow people to live through it before they set their risk appetite, might actually be helpful. Because for a lot of people, their risk appetite is significantly less than they stated to be in calm markets.
I appreciate that, Jacques, and I'm going to come back to you in a moment also to tell the story, provide a little bit of context for everyone about the creation of one of these risk statistics, value at risk. But Allison, let me turn to you next and keep it high level. There's a couple of questions on the table. What is a default in behavioral terms? You've also just heard a story about how there are global or general defaults set for this profession by CFA and by GARP. They're meant to be global or general, but they're being applied in a specific circumstance by long-term investors. Jacques has called forward some ideas related to loss aversion, risk appetite as well. I presume there's an issue about making sure that you're applying them well and in a savvy and informed manner. So can you tell us what is a default and how might you apply a general default to a specific circumstance?
So a default is one way to look at it is it's a set of assumptions that underlie decision making that tend not to be on the table when you're having a conversation about what to do. So the word sort of says it all. If you set a default, you then tend to take it out of the conversation. But we know, and we've heard from the speakers already, that there are trade-offs between the long term and the short term. And we know from experience that long-term investors even though in theory they understand there'll be some short-term losses. They tend to want to have their cake and eat it, and they tend then to respond quite negatively when there are short-term losses. So Ian started off talking about consistency and comparability, and I certainly get that. I certainly get that we want to avoid complexity and cognitive overload. But my question, I guess, would be, what do we lose by flattening this and trying to get that consistency and comparability? And then, I mean, I actually like this idea of simulations, and I don't see why that couldn't be created. So how much thinking has been done about how to communicate these trade-offs clearly? I assume that nobody is spending time discussing the defaults because they are the defaults, and people are getting you're overwhelmed with a tsunami of other information. But what do we lose from having things set up that way in order to avoid complexity would be my question.
So Jacques, let me give you a chance to tell that story in the context of one specific measure, value at risk. You were around when it was created. Can you tell us the story of its creation and also draw out some of the themes Allison just mentioned and how it's used today by long-term investors?
Yeah, absolutely. And I'll before I go there, I'll do what politicians do. I won't answer your question, but talk about something else first. I'll just mention to Allison that one of the challenges, of course, of creating all these simulations and presenting it to clients is you get into Ian's issue of too much information and then people don't read any of it. And I think that very often people do that. They will present sort of different scenarios, but then you get a pretty big deck. And I think that's one of the challenges is how do you present it in such a way that you don't have information overload. But with regard to value at risk, so I was at JP Morgan when that sort of tool was originally developed and then popularized. And it was developed essentially to meet a very simple objective originally, was to provide Dennis Weatherstone, who was the CEO at the time, with a daily snapshot of what the risk of the trading book actually was. And his question was very easy. He once asked a bunch of people at a meeting, how much can we lose in this portfolio over the next 24 hours? And hence, basically, everybody turned around and said, all right, well, let's create a 24-hour risk metric at the 95th percentile confidence interval, and there you have your VAR measure. So it then got a life of its own through the creation of risk metrics, and then ended up in some cases being sort of not necessarily applied in the right way, and tended to force a shorter term horizon on a number of people who probably should have had a slightly longer one. But it did end up sort of over time identifying an interesting other trend in the industry, and that's what I would call sort of constant versus non-constant use of a risk budget. And one of the things I've noticed is that if you actually look at the sort of asset management industry broadly defined, you've got people who grew up in the long only traditional asset management space, and then you have people who originally came from those proprietary trading desks at banks who developed these VAR concepts, who ended up then moving out of the banks and creating hedge funds and sort of alternative type strategies. And what you find in the behavior of both of these populations is that the first one tends to have a constant exposure to risk. And as a risk manager, we kind of monitor that, right? When we look at tracking error of an equity portfolio manager against their benchmark, we're saying, well, they're running 350 basis points of tracking error pretty consistently. If I actually look at at somebody who grew up in the sort of more trading environment, you will see that the risk appetite goes up and down. And what will happen is if that investor has no view on the market, their risk will be zero. They will not take risk. And it goes back to that experience on the trading floors where if you had no view, you had no position. And a lot of these trading desks made their money by basically having 2 good bets on in any given year that maybe took 3 weeks to materialize. which made a lot of these traders very good video game players, of course. We still have that. That's kind of a remnant of how this industry evolved, and it therefore has an impact again on kind of the default time horizon that people have, because that's kind of what they grew up with.
For sure. I appreciate that example, Jacques, because I think it helps bring the issue to life. Ian and Mark, I want to go back to you with a follow-up question from your opening remarks. You both emphasized the terms consistency and comparability. That's for any type of investment risk professional or investment strategy. It's global and it's inclusive. It's not meant specifically for long-term investors. It's meant for any type of investor. Am I right in understanding that? And can you talk about the way in which your organizations envision a subset of investors, long-term investors, using your general either certification or investment performance standards? I'll start with you, Mark, this time.
Yeah, I think you're right. It is general, but the details of how you go about it are going to depend on the investment horizon, to some extent for the reasons we discussed earlier, right? The market has different moods, different phases, and if you're going to capture them in your measures of risk, they're going to have to be, they should be different for different investment horizons. For a product that is being marketed as having a 10-year, horizon, daily VAR is not going to be very helpful at all as an indicator of what the risk posture is.
Terrific, thank you. Ian, would you add anything to that?
Well, yes, I would. And also to Alison's comment about if we have defaults, what might we be losing by ignoring the additional? And I suppose what I would say with respect to the GIPS standards is, what we hope is we've captured the minimum set of information that will also stimulate then the additional discussion that is necessary. The investor knows what they're looking for, or thinks they knows what they're looking for. And given this base set of information, which hopefully is a foundation that they can then be built upon, they can have a two-way conversation with the product manager about whether it can deliver what the investor is hoping it can do. So we've got this foundation level. What we want to get away from is the whole discussion being around the quality of the data. What was the valuation you did? Was it fair value? Was it not? What was the timing of the various trades? Is income in there? Is the cash? All this sort of stuff. That should be the default. There should be a standard around that, so that the quality of the information that is being received, albeit the minimum set of information, is without question. And then it's people, process. The discussion is about that, and also the risk horizon, the time horizon as well. Knowing that the baseline set of information is comparable, consistent, full, and fair. That's the key thing. The other thing to build into this, the long-term time horizon, is building trust. If you can get the things that you can control right, and you deliver them to the investor in a consistent fashion, that, believe it or not, builds up trust. And that trust is going to be really important when you, the manager, need to be carried over the blip. If you've got the baseline stuff right, then you work as a partnership, okay, rather than you're only as good as your last trade type of issue. The long-term horizon needs the hand-holding through the timeline of the product. So kind of a bit to Alison about what have we lost? Hopefully nothing. What we're doing is stimulating further discussion, building trust to carry for the long term. So you work as a partnership.
Sure. Thank you for that, Ian. Alison, I'll give you a chance to reply, and then I also have a follow-up question for you. But would you add anything to what Ian just said?
Well, I'm confused about how a default would stimulate discussion if it is indeed a default, and multiple people have made the point about information overload and needing to take things off the table. So if we're taking that specific thing off the table, I'm not sure how it gets into the conversation. And then I would kind of add just one point, that it isn't so much, in my understanding at least, that we've got a difference between short-term investors and long-term investors, because long-term investors by definition need to consider multiple time horizons.
Right.
So the issue is not that they don't need to consider the short term, they need to consider the balance between the short term and the long term. So in that sense, from my uneducated stance, it seems that long-term investors have fundamentally different needs and fundamentally need to deal with more complexity around risk. And given humans dislike conflict and trade-offs, that seems problematic.
So Matt, you and I have talked about this before at other meetings as well. And I think, Allison, this is exactly where you're getting to, is if you're a long-term investor, you've got sort of some sense of what you want the distribution of returns to look at maturity, and that's the horizon. But you have intermediate horizons where you may have thresholds that you are not ready to go below. So it's a multi-period optimization problem where your objective is long term, but you've got constraints kind of at every point along the timeline that gets you there.
If I could just interrupt.
Please go ahead, Mark.
I mean, there's another aspect here too, which is the long-term investor may, buy a product, invest in a product, but part of what they're doing as time is rolling on is deciding whether their investment manager is doing what they want done or not. And, in the worst case, they're deciding that the investment manager has misled them. So a way in which the defaults that Ian is talking about are helpful is that they make it easier for such a long-term investor to compare one investment manager against others. The defaults are not going to be enough, in my view, for a long-term investor to do that completely, but it's going to be helpful because you've got kind of apples to apples numbers. But it is going to be important that the investor understands what they're getting with the defaults, right? That's sort of the primary purpose of them. It's not to tell the investor, whether long or short term, that this is all they need to think about.
Allison, I'd like to put a question back to you, and then Ian, I'll come back to you. There's a tension that is implicit right now that I like to make explicit, and that is, it is important to understand the default assumptions that you're making. But at the very beginning of the conversation, you defined default as the sort of assumption that you make and then it recedes into the background. So I want to ask a very simple, high-level question. Why is it important to know these things? Why is it also important to make sure that you're using a tool that is fit for purpose? And how do you navigate a circumstance where the defaults exist, but you've not asked those questions before? Can you talk a little bit about how a behavioral scholar would grapple with the fact that you need to know things that by definition you don't?
Well, I think, I mean, where this conversation is going is reminding me a lot of artificial intelligence and algorithms. So certain assumptions are designed in, there's training data, and then there is a tendency to just look at the outcome and assume that that is truth and fact because it's designed by a machine. So it seems that there is a huge tension here with the need for consistency and comparability in the default, the fact that there is not, in reality, the energy to kind of educate people on the design of those defaults and the implications every time you present these results, but that everybody needs to have them top of mind. So, I don't know what one could do other than a reminder of kind of first principles and these assumptions and the trade-offs at the beginning of the presentation of this information. That would be very important. I go back to this idea of the simulations and the understanding of the trade-offs, but I guess, you know, I'm trying to picture what's happening in the room when these issues are being discussed. I assume that things are being, you know, everyone's been very clear, there's an overload of information kind of coming to these people. And it seems on the face of it that there would be very strong drivers preventing the people in the room from asking questions about these underlying areas because there's so much other information on top. So it sounds as if we're ending up in a situation that is suboptimal, at least from the position of long-term investors. And that may be fine, given that investors have different needs and we do need this consistency and comparability and we can't discuss and debate everything. But if long-term investors have different needs, then there does seem to be a strong imperative to more explicitly design those needs and trade-offs into what is being communicated in a more consistent way. Because this stuff is also very technical, it's very quantitative, and of course risk is responsive to that, but we also know risk is a very emotional topic.
Indeed, indeed. I'm going to, Jacques, give a last word in this segment to you and then turn to some more specific examples. Allison just talked about what it must be like to be in the room when you're facing these decisions and what it must be like to manage risk in a multiple horizon way. You're a part of this conversation because you do this every day. What is it like to be in the room? How do you do this?
So I think that, you know, Allison pointed out correctly, you know, one of the most important aspects of it is to try and keep the, you know, emotion out of it, and stick with the you know, going back every time to kind of what are the principles guiding you in terms of what you're trying to achieve. And actually, I must say, you know, the simulation sort of is helpful in these times of sort of, you know, market stresses, but market stresses sort of occur, you know, actually they occur more often than most distributional assumptions make, but that's another discussion. But they don't happen that frequently. What I actually find is that we find ourselves as risk managers in a lot of cases spending a lot of time arguing with people who are not taking sufficient amounts of risk. And so if on balance, I took, you know, the last, 20 years of my career and counted the number of days where I had conversation with, you know, you're like way behind in your, you know, usage of your risk budget versus you're taking too much risk, I'd definitely be like, you know, 4 or 5 to 1. So, you know, we actually find that a lot, and that's a discussion that we have to have because, you know, that's the discussion our people are going to have with their clients who say, like, I pay you to take risk. I don't pay you to be a closet indexer. And so, that's a constant conversation. And it's actually sort of, again, going back to my distinction between people who take risk constantly versus people who take risk opportunistically. We haven't literally reconciled that debate yet between those two sides of the industry. And very often we haven't had that conversation with our clients. You know, do you expect us to take risk constantly, or are you okay with us, you know, having, you know, 3 good bets a year and then kind of running close to benchmark in the meantime? Those are discussions that, you know, our marketing people typically don't have. And I think they're somewhat philosophical, but they'd be useful.
We do have one question from the audience. Ian, I'll give it to you first and then ask Allison to chime in as well. It has a little bit of a predicate to it and then the question. So here it is. As someone in the investment business before GIPS came into being and seeing every private equity fund seems somehow to be top quartile, we can't overstate the importance of GIPS discipline and consistency. It's great to do simulations also, but the discipline is not always the same there to call them GIPS compliant. So the question is about an alternate way of handling some of this default setting. Could GIPS encourage reporters through its examples or through its guidelines to just switch the order of performance and risk reporting so that long-term figures precede short-term figures in the table? And would that help reset the default? So Ian, you first, and then Allison, your thoughts about that potential nudge.
Okay, thank you. GIPS actually does not have a pre-described format for the minimum set of information that needs to be delivered. It's a set of information, but how each provider generates that, as long as it's all there, is up to them to decide. Plus, what we require is annual information. So each individual stripe of information is equivalent to every other, but of course, some are much further back in time than others. I do see from some of the information that I've read that there are places where, 10-year reporting is the stuff that is highlighted and year to date is ignored completely, or maybe, laid somewhere at the back in order to focus on the longer term information. Points earlier, you're going to have intermediate checkpoints along the way. So again, our table of information is 5 years, annual, building to the 10. Again, this is also from a GIPS perspective, and I think we need to distinguish this. This is what you are presenting to a prospective client. So somebody who has no means of communication at all with the people they're receiving the information from initially. This is not about communicating to an existing client. Now, if an existing client doesn't like what they're getting or not getting the answers they want, it may be painful to say, I made the wrong decision to this manager, but ultimately they go elsewhere. And they do that. Now, there's costs associated with that, and nobody likes to admit they got it wrong. And those are the behavioral issues which to make these things a bit sticky. An existing client has a lot more power than a prospective client wondering whether they should invest in the product or not. So again, we prescribe a minimum set of information. We do not prescribe how that should be presented. But if somebody's looking, they should ask these questions. Is this suitable? Is this relevant product for me?
Thank you. I appreciate that. And I did not, in fact, know that choice was available to the manager or individual entity doing the reporting. Allison, to you, how important would it be to default to your appropriate time horizon rather than just going chronologically?
I mean, extremely important. And I think so that ought to, on the face of it, make a big difference. And it's kind of interesting and it's self-right to learn that the presentation is not a default, but everyone on the line thought it was a default and didn't have kind of any means to change that. So that, I think, is the perfect illustration of why defaults are important. I was interested as well in what Ian said about how, once the relationship is established, you've got a lot more power, a client has a lot more power to challenge if they're not getting the information they want. I would just query in practice, do the clients know what they don't know? Would they be able to target what's going on in those defaults rather than some other aspect that's front and center? And so, yes, in theory, they have the ability to challenge whether they're not getting the information they want, but it's hard to identify an absence. Like, I have a feeling I should be getting this information I'm not getting, rather than attacking and unpicking the information you've got in front of you. So I think that's a big ask, to ask people to identify the absence and follow up on it.
There is this requirement, as we understand it right now, to annualize from monthly volatility in order to be compliant in reporting both volatility and sharpened information ratios. Why is that?
Okay, the actual requirement, the only one requirement we have is the annualization of 3-year rolling standard deviation using monthly returns. Now there's a whole heap of pragmatism that went into that. First, you need enough information for whatever distribution you're looking at to be interpreted fairly. Okay, so we're not going to do 12. You could do 24, 36, okay, 60. If you're waiting 60, you've got 5 years of product, which is out there trying to be sold by others, which doesn't even have that risk measure associated. So you come somewhere in the middle, we end up with 36. Now, monthly, we require for non-IRR products, and I must say all we're talking about here is time-weighted rates of return. IRRs are dealt with in a whole different perspective, which is probably another set of discussions. We require monthly returns to be used as the basis for all of the information that is being generated. Now, are we going to require a whole different set of returns for the comparable risk measures that we're asking for? And again, we only are looking for a volatility, the annualized 3-year standard deviation, as the standard required risk measure. For Sharpe, information ratio, tracking error, maximum drawdown, whatever, that would be presented as additional information and disclosed how it is done. So the only one we are actually putting constraint around is that 3-year annualized standard deviation that use monthly return. I absolutely agree that if you use quarterly, if you use annual for the same time period but a different frequency, you will end up with different numbers, which is why we said it must be monthly. You had to pick something. Annual's not going to work. Quarterly, 12, not going to work if you're going to hope to get a measure in there for 3 years. So this is how it ends up being a sort of pragmatic approach for that. Anything else, the provider has to disclose what they've done, and where they're using a comparative, it must be generated using exactly the same frequency. So 3-year annualized standard deviation monthly on the product and on the benchmark. So you can't get deviations coming in because you select a different frequency for the underlying data that is being used. So it's not quite as bad as Will said, but it is a compromise, and we want a comparative number. For good or for ill, that's what we settled on. Providers can produce additional information, disclose why it's more relevant, and the way they've done it, and make sure that the comparative is done in the same way. That's the additional information beyond the default. And then that gets conversation going.
Let me follow up with one question. Sorry, go ahead, Jacques.
If I can actually comment on that.
Please.
I think also an important distinction is what the risk measure is actually used for. And in this case, if you're actually using a historical risk measure based on the methodology that Ian just described, it's because what you want to do is you want to calculate risk-adjusted returns. It's all sort of historical data. As a risk manager, I have relatively little interest in that. I'm interested in the prospective risk measures of the current portfolio. Hence, I'm going to be running this through a risk engine because I'm actually thinking that risk is a forward-looking measure. So again, as Ian was pointing out, everybody has to understand what the purpose of a particular metric is before it's used. And I know that in our reporting, we do the same thing. We annualize sort of standard deviation or information ratio measures. But these are just to sort of give a sense of what was. Being on the risk management side, I'm more interested in what is to be.
Yes.
I have follow-up questions for both of you, and then we'll turn a little bit more. Ian, just to follow up though on that idea, we all know, of course, that these figures are reported for different time periods, and one alternate, hypothetically, might be that the period of observation would become longer as you are reporting on longer time periods. That might alleviate the concern about the availability of data. So for instance, if instead of 5 years, you were reporting on 10 years, you might be able to observe longer term volatility and still have enough data to do so. We certainly appreciate the point though about consistency and comparability. So you don't want to have one reporter construing their 3-year figure in one way and another reporter construing their 3-year figure in another way. Would it be possible though to use longer term observations the longer your reporting periods are in that table? Is that practical?
Well, again, the table builds from since inception or 5 years, whichever is the shorter, building up to 10 years in total. It is the managers' discretion whether they wish to include more information than that, or indeed for the recipient to go back to the manager and say, hey, I want to see the business cycle, which I'm thinking is 25 years or whatever it may be. If your product's been out there that long, send me that. Again, this is the minimum set of information to stimulate conversation.
Thank you for that.
So anything they like.
Absolutely. I'm going to go next to Jacques because Jacques, you will be much more creative and insightful than I will. Have you found a way to improve upon the going in default in the way that you communicate about long-term risk-adjusted returns? And then, of course, we know that the issue of prospective risk calculation is entirely differently. But is there another longer-term way to do this?
No, I think that for the purpose of calculating sort of risk-adjusted returns on the past, you've got to map the volatility to the period over which the portfolio was managed, and I think that's interesting. But and I think that one of the challenges of lengthening the horizon, or lengthening the period of history over which you measure that, brings in a whole series of other issues, which is regime changes in markets, structural changes, et cetera. Right. And so we're having these discussions exactly right now on sort of sectors of markets where the dynamics have changed so much since the great financial crisis that we could be running numbers on a particular set of circumstances that are essentially meaningless. And I can tell you, a perfect example is in the high yield muni space, which is an area that had quite a bit of stress in the first quarter of this year. We were running stress tests before the first quarter of this year. What happened in the first quarter was 3 times the size of the stress test that we had run. So you've got to be sort of careful about sort of exclusively relying. I was hoping that I was going to be ending my career that the worst stress test that we'd ever seen was the great financial crisis. Well, I was wrong.
Yeah.
But I think that it's important to understand sort of the limitations that you bring in the longer sort of the historical pattern that you put in place, because there are too many things that structurally change over time.
Thank you. Allison, I'll ask you a high-level question, and then Mark, we're going to turn to a last question about the FRM. Allison, what we've heard, I believe, is a situation in which perfect can't be the enemy of good enough. That there might hypothetically or mathematically be a situation in which you would do this differently, but for reasons of data availability and global consistency, there's certainly a rationale for how we've arrived at this default. I'm curious if in your work there's been other instances in which you had to default to something that was good enough but not perfect, and how behaviorally that affects people, how you might use a default knowing that it is good but not perfect. How do you handle that situation?
I mean, there are numerous examples of people using things that are good enough but not perfect. And in general, right, this is the problem with risk is in dealing with low likelihood, high impact issues in general. That's a problem kind of in general. I mean, the thing that really struck me about the last 15 minutes or so of conversation is how much discretion is in the hands of the manager in stimulating discussion, in communicating. We heard repeatedly, this is a minimum set of information to stimulate discussion. So I guess I'm leaving or coming to a concern about how able those people are to stimulate discussion about this particular default issue, how much that is on their radar, how able they are to communicate these trade-offs between the short term and the long term, and how we are educating them to have these conversations. Because again, if we think about what is in the questions in the room and asking about the unknown unknowns, I'm slightly concerned that a lot of energy is going to the things that are not default, because those are important as well, and that neither the communicator nor the listener is paying attention to this issue. Whereas it seems extremely important. It seems that there are very good reasons why we've set these defaults, but that they have very differential impacts depending on the motives of the investors.
Allison, you couldn't have given me a better segue to Mark if you tried. We're now talking, Mark, about people needing to be creative and use discretion and employ their expertise in the way that they do this work. And GARP creates this FRM certificate in order to certify people's skill and acumen in the profession. Can you just respond to what Allison said and talk about the ability of an FRM certified risk manager to do what she described?
So my takeaway from this whole hour of conversation was that if I was trying to be a responsible runner of an asset management firm who wanted to be in business for a long, long time, that's a different kind of long horizon, right? Mm-hmm. You know, when I had conversations with clients, I would say, well, let's start with the GIPS. And let's understand that any standard or any set of numbers is developed for a particular purpose. And the biggest purpose of the GIPS is to allow you to compare one asset manager with another without having to go have a 5-day conversation with each one of them, right? And in order for that to work, it's got to be prescriptive in some respects. And, you know, it can't be too complicated. It cannot capture, you know, the full panoply of risks that you as a client of my firm are going to have to deal with. So let's just quickly look at these GIPS numbers, and then let's have the real conversation. Let me try to teach you how to think about risk in a broader fashion, how we think about risk. And let me, you know, remind you that you might panic, right? And you ought to think about what is going to happen to your return if you panic in bad times. And so you're going to go off in a conversation that is very specific, very bespoke to each asset manager, right? And, you know, a very sophisticated client is going to have such conversations, at least at the hiring stage, with a number of asset managers and come away with a view of who they are most comfortable with. You know, how can an FRM help with that? You know, the FRM certifies that somebody kind of understands the broad range of risks and risk management tools. But in order to do what Jacques does, you know, you've got to have a lot of experience as well. So I would say the FRM is the first step down the road to being able to organize the conversation, the big conversation I was just talking about.
I appreciate that, Mark. I want to draw also on the prep conversation that you and I had last week. The metaphor of a highway, staying in your lane, understanding the pathway, and also being alert to the destination that you are seeking came up then. And my understanding is that achieving the FRM in some ways helps a risk manager appreciate that highway. You don't just have your head down looking at the next step, but realize that you're on a path. Can you unpack that a little bit and share with the group today what you shared with me last week?
Well, I mean, the typical junior risk manager is focusing on a particular kind of risk. You know, even an asset manager, you know, the junior person is going to have a particular focus, or, you know, something that people may understand a little better. In a bank, you know, they're going to be managing credit risk, market risk, operational risk, different kinds of risk like that. Somebody like Jacques has to managing that risk, right? He's got to manage who's going to do these things. And so not only does Jacques have to make sure that everybody who's supposed to be managing a particular lane of the risk highway is doing that well, he's got to think about, you know, are there enough people in each of the lanes? And he's also got to think about what's going to happen when the vehicle leaves the highway entirely, right? And how is the firm going to deal with that? both internally and in terms of dealing with the client. So internally, if you have a portfolio manager who leaves the highway, who's not following the mandate, there's got to be a means of detecting and disciplining that. And then in dealing with the clients, there's got to be a way of dealing with it. So risk is a very complicated thing. And there are business benefits to doing it well.
For sure there are. Jacques, I'm going to give you the last content word, and then I'll ask just an administrative question to Ian and Mark, and we'll wrap up. But I think one thing that we've heard from the discussion today is that Jacques Longerstay and people like Jacques Longerstay are very important. Not just expert and trained, but experienced and able to use discretion. So I would like to hear a synthesis from you about where the practice of long-term investment risk goes from here, given what we have heard today. What do you think is the next frontier for managing multiple time horizon risk with an eye toward the destination?
I think that I think it was Allison who sort of raised the question of we should always question all the defaults and actually all the defaults that are in the conversation, not just the numbers, because we talked a lot about practices and sort of do I put the 10-year before the 3-year? But I actually think we need to fundamentally spend time with our clients asking the higher end questions of what is your investment objective? Because you can really only estimate risk. The risk is the probability of not achieving your objective. Let's get clarity about what the objective actually is. And sometimes people don't even have that conversation. And then I've had that conversation with if you're a pension fund, you really have a pretty good sense that meeting the pension requirements of your participants is a requirement. But I've had these discussions with sovereign wealth funds, not exactly sure what their long-term investment objective is or what their social function actually is. And some of them may criticize my saying that, but I've had discussions with them and it's not obviously clear. And if it's not clear, it's going to be really hard to actually create a risk measure off of that. So I think that's those are some of the discussions that we need to have. But also, I want to comment on Mark's point about all the swim lanes and what risk managers actually do. I think the most important thing as a question that risk people need to ask themselves constantly is, what am I missing? I've got a lot of tools. I tell my folks all models are wrong, some are useful. And at the end of the day, we have a lot of data and I have a lot of information, but it's the pieces that are missing that we need to look for.
Thank you, Jacques. I'm going to have to interrupt.
Forgive
me, I'll have to interrupt to leave it there. Because we are nearly out of time, and I do want to make a point of thanking each of you today for being part of this conversation. Ian McCarr, Mark Carney, Allison Taylor, and Jacques Longerstay. We appreciate each of you. I also want to make a point of thanking my colleague, Bryn Costello, who produced today's episode of the Risk Webinar and on whom I depend for the success of this each month. FCLT's purpose, again, in convening these webinars is to move money in longer term directions. And in that spirit, if anyone in the audience today heard something that they would like to learn more about, I'm available to help. You can reach me at matthew.leatherman@fcltglobal.org. Again, our resources are available on the webpage, fcltglobal.org/resources. We hope that everyone will join us on the second Wednesday of November for our next episode of this webinar. This will be on the subject of climate, from uncertainty to risk, with speakers from the Hong Kong Monetary Authority and from Wellington. With that, thanks to each of you again and to everyone in the virtual room as well. And we look forward to seeing you next month.
Thank you.
Thank you. Pleasure.
Thank you.
Thank you.
Bye, everybody.
Bye-bye.